There have always been investors who wanted to do the right thing, who wanted to put their money in the stocks of companies that were socially responsible. The problem was that for decades, the general prejudice was that if you wanted to do something right, you were going to have to pay for it. In other words, if you wanted to invest in a socially responsible way, you would have to accept lower profits and lower stock returns. But there's a growing body of research that shows that companies that behave in a socially responsible way actually wind up outperforming companies that don't. So the challenge is, how do you spot the socially responsible companies in advance? Arabesque, which is a London-based firm that's a spin-off of Barclays, has been grappling with this question since about 2012. Today, Arabesque has a database that covers more than 7,000 companies, and it draws information from 50,000 news sources and from about 8,000 NGOs, all designed to see how well these companies perform on what they call ESG, which stands for environmental, social, and governance. Those are the three bases of corporate responsibility that almost every investor is thinking about when they want to try to pick a well-run company. And Arabesque runs a whole bunch of different indexes and scoring systems that are essentially based on ESG performance. So how would an investor use these ESG metrics? They're not the world's greatest predictors of how just one stock would perform in the short term. But what Arabesque has found is that if you use these metrics in bulk, if you say buy an index fund or a mutual fund that invests only in the 20% of companies with the best metrics, then you're going to find that you're going to outperform the market in general. In fact, Arabesque has found that the companies that perform in the top 20% on their ESG metrics consistently outperform the companies in the bottom 20%. One thing that the ESG metrics can help you do is spot in advance the companies that are more likely to have a meltdown in the short term. So for example, Arabesque's mutual funds, which use its ESG scores, never did invest in Volkswagen or Wells Fargo or Facebook. And of course, as we all know, those companies each had pretty big stock meltdowns after some kind of scandal emerged over the way they were managed and the way they were handling their business. So now that you know that there's all this ESG data available, what are you going to do with it? Here's our advice about which way to go and how to steer your money to take advantage of this. Ingersoll Rand is a company that scores very highly on Arabesque's rankings, and they specialize in industrial products, especially HVACs, the systems behind your air conditioning and your heating. They've been working very heavily over the last couple of decades to make their HVAC business much more energy efficient. Last year, Ingersoll Rand's quarterly business in HVACs was increasing by about 3% a quarter. Now it's increasing at about 17% a quarter. And that just shows how much customer interest there is in these energy-efficient HVAC systems. Another manufacturer that gets great scores from Arabesque is Cummins. Cummins makes diesel engines. For a couple of decades now, they've been among the leading specialists in clean diesel. Demand from China and other countries with serious pollution problems has boosted revenue for Cummins' clean diesel business by about 20% over the past year. And because their stock is relatively cheap right now compared to their revenue and their earnings, a lot of investors see that as a great buy for down the line and a chance to get some stock appreciation and some price growth, even if the overall economy gets a little rockier. Texas Instruments. If you've been following the headlines, you might have noticed that not that long ago, Texas Instruments actually pushed its CEO out the door because of unspecified personal conduct issues. But interestingly enough, socially responsible investors see this as a good sign. It's a sign that the system's working, that the board is strict, that they're not going to let anybody monkey around and try to bend the rules. And so investors have actually responded to this news pretty positively. The stock dipped just a little bit, then it rebounded. Texas Instruments brought back their old CEO, who had actually been a big engineer of their success. Their stock price has doubled since 2015, and a lot of people think that, especially now that they've cleaned up things in the CEO's office, the sky's the limit. The bottom line is that being socially responsible is good for your bottom line. And as more investors recognize that, that effect is probably going to multiply. So the more you can steer your own investments into a group of companies that score well on governance, score well on social responsibility, score well on how they relate to the environment, probably the safer your portfolio is going to be, and the more likely you are to outperform the market in the long term.